Hello, this is David Jensen with your February 21, 2023 Economic and Markets Update. The discussion today is going to be titled Uncontained Price Inflation, Central Bank's Dirty Big Secret. First of all, if you like this presentation, please do give it a thumbs up and subscribe. I post at the following social media platforms. You can find my commentary and thoughts there. As a recap from our last discussion, we're going to start there because gold and silver have historically impacted interest rates and thus the economy and markets. So in summary of the last presentation, the Bank of England, which is the central bank of Britain, and the money printers there, they set the quantity and interest rate policy for the country. They were given oversight of the London gold and silver market in 1986. With the Thatcher government's Big Bang financial system reform, as it was called. Now, gold and silver have historically warned of excess money creation by the central bank money printers. The London market is a very important market in terms of seeing 88% of the global turnover. That was an estimate by Bullion Star. The Bank of England created the London Bullion Market Association in 1987 after it was given oversight, and this association of traders was given the role of general oversight of the markets. Now, the BOE approved the trading of unallocated promissory note spot contracts. Now, those are immediate ownership for actual bars of gold and silver. But the Bank of England allowed trading of promissory notes instead of trading of actual metal itself. And they also facilitated the voluntary conduct codes for traders. So their oversight of traders consisted of a voluntary conduct code, which the traders could or to choose, or they could choose. They could choose to follow, or they could choose not to follow. So the net of it all is that price discovery of gold and silver was disabled in terms of actual supply and demand factors by the BOE central bankers, allowing trading of unlimited gold and silver promissory notes. You can create promises without limit, and that's what the trading of these promissory notes essentially allowed, versus the historical trade of physical allocated bullion, which is limited in supply and is affected by actual supply and demand. So what happened with money and metals after the 1970s? Well, as a recap here, from 1970 to 1980, the M2 money stock, this is the money stock, which is the money in the U.S. economy, the M2 measure, from 1970 to 1980, it increased about 2.7 times, roughly from 0.6 trillion to 1.6. They had about $1 trillion worth in that time, or 2.7 times the prior amount. And gold and silver saw a 21 times for gold and a 24 times increase in price for silver during that decade in time. From 1980 to today, we've seen an increase of M2 of 13.5 times. So it's gone from 1.6 to $21.6 trillion. But gold and silver have been muted. They've only increased in price from the 1980 high by twice for gold, and silver is less than half of the 1980 price, despite the debasement of the currency over that period. Now, what was the economic and market impact during this time? So the hobbling of gold and silver, which are the monetary inflation warning system, they warn us when interest rates are too low and the central bankers are printing too much money, in essence. We saw a secular decline in interest rates as measured by the Fed funds rate from 20% in 1980 down to zero as recently as last year. And that has driven an increase of the bond market as measured by the total debt securities level from roughly $2 trillion in 1980 up to $58 trillion today. So that's a 29 times increase in the debt market size. Now, if monetary or currency inflation drives price inflation, what happened to price inflation during this loose money period? The Wall Street Journal calls this the Great Moderation. They wrote a number of articles where they were very quizzical as to how can the money supply increased so much and the markets are flying, but interest rates are low along with inflation. How could this possibly be? So let's have a look. Now, the muted CPI price inflation that occurred despite loose monetary policy during this period. We can see M2, how greatly it increased, so that you would expect the debasement of this currency to drive intense price inflation. But we can see that the inflation rate, as measured by the CPI, dropped from 18-ish% here in 1980 down to zero a couple of times, and over the last decade around 2%. Meanwhile, M2 increased by more than 5% per year for decades on end. So if currency inflation or monetary inflation drives price inflation, where did the money go? And the answer here is one of the key repositories for all this money creation was it went into debt securities. So as you have secular dropping interest rates, that drives the bond prices higher and attracts capital. And what happened was that the debt securities market was supercharged. The bond market was supercharged up to today's $58 trillion level. And it also drove the stock markets much higher because everybody knows that loose money and low interest rates lead to a frenzy in stocks. So we had many decades there from the mid-'80s until today of incredible financial market performance. But as we see the note here, we now have a problem, and it's a big problem. The spiking interest rates from the recent spike in M2 money, it increased by 40% in terms of the total amount outstanding over a relatively short period of time since early 2020, the onset of COVID. That has now driven price inflation. We've seen 8% recently, and now we're in the 6-ish range. But this spike in price inflation driven by the central bank monetary policy has driven interest rates from 0% up to 4.75% now in less than 12 months. And the rates are still rising. Now, this is a problem. We've got a bond and a stock market which are dependent on this money. And as we see here, there are two key issues now, is that the debt now is increasing much faster than GDP. So you get twice the increase of debt outstanding for every, units of debt outstanding for every unit of GDP growth. And the economic growth is now totally dependent on this continued increase of debt, even as the interest rates are spiking and the debt markets are starting to become relatively more illiquid. And the spiking interest rates are going to cause debt default and a decline in debt appetite, both for borrowers and investors. And this means that the debt Ponzi that has been run since the 1980s cannot be sustained at a higher interest rates. And we will see a drop in the debt markets and in the bond markets, as well as the equity markets, now that the liquidity is drying up. So as high rates inevitably choke the debt bubble and heavily devalue bonds and stocks, the capital starts to move. As these markets come down, the capital in these markets is going to go elsewhere, and it'll relocate into real assets with durable value. You're going to have a financial market problem and a currency problem. Investors are going to quickly figure out that the way to protect capital is to hold assets of durable intrinsic value. So that includes gold, silver, food, energy, as just some examples. And these are small markets. You know, $1 trillion or $2 trillion can buy up these commodities that are available to market. And this will drive rapid onset of extreme price inflation. When you've got bonds alone being 25 times, for example, the size of the commodities, gold and silver market, I'm talking just in terms of liquid commodities and gold and silver monetary assets that are available to market, you're going to see a very large increase in the price with a very, not a large movement of capital into these markets. that'll expose these decades of really a go-go fake economy and fake financial markets that was really driven by excessively cheap money in the containment of the market's awareness of inflation. So the central banker's dirty big secret here, we're watching for signs of the onset of this explosive decompression of the bond market. So one thing to follow is the MOVE index, which is the Treasury Volatility Index. And this measures the size of the movements daily, weekly, monthly, whichever you choose to set your indicators for. But it measures the size of the movement in these periods of time. So we see here back in 2009, interest rates were actually plunging, but they were plunging quickly. So we see a spike here in the daily volatility. And we saw a quick plunge in interest rates here at the beginning of 2020 with COVID, and we again saw a spike in the MOVE index. Now we're seeing not a quick drop in interest rates, but we're seeing a increase in interest rates at a relatively quick period, over a relatively quick period, which is spiking up this MOVE index measurement. So to recap, dropping interest rates here, dropping interest rates here, rising interest rates here over relatively short periods, driving up the MOVE index. So this is a 5-year chart on a weekly basis, and noting here that there's been a pretty steady increase in the volatility in the bond markets as the price inflation has come to the attention of the bond markets, and they're seeing the interest rates moving up as a consequence. A recent drop-off, but now we've had 2 weeks here of rising MOVE index measurements. So I'm watching that very closely to see if we have a turning point here where this is going to continue higher, along with continued rise in interest rates and the onset, I think, of the crisis phase of the breakdown in the bond and equity markets. So implications of all of the prior policy and what we're seeing now in terms of inflation. The banking, we'll see, I believe, a banking crisis that will accompany a bond market crisis, because the banks hold loans and bonds as the vast majority of their assets, and the devaluation of these assets hit the bank balance sheets, causing problems there in terms of insolvency. Now, the banking and financial crisis will drive capital quickly into physical assets as mentioned previously, especially gold and silver, and privately held, not held through promissory notes or exchanges, because all of these are going to have trouble due to the onset of this currency crisis that's going to come along with the banking and financial crisis. We'll see physical shortage in London and New York, ending this multi-decade gold and silver promissory note price rigging system run by the central planners. Again, we saw this with palladium in 2016. Physical shortage led to the price moving up by 5x, 5 times in a couple of years. And the reason for that is that people don't want promissory notes when there's physical shortage, and they need the actual metal itself. And the metal itself is going to come into vogue as we see the onset of this crisis. So this will lead to a reset, let's call it the great gold and silver price reset, as we start to see actual physical supply and demand setting the price. And a rapid onset of price inflation, of course, is going to hit consumer goods inflation, which is going to be very bad for our society here, as the paper market and the age of paper comes to an end. Capital is going to move into real assets and expose this Ponzi scheme that's been going on for decades here, run by our central planners. So this is the end of the presentation for today. Thanks again, and once again, if you do want to follow me, these are the social media platforms in which I post. Thank you for your time, and I look forward to our next update.